Hi, I'm Paige Deers. I'm here at the MBA conference in Atlanta, bringing you insights right here from the show. I'm with Mike Melody of Jones Lang LaSalle. And Mike, let's talk about the way that 2011 ended. How did the debt markets end, and what can we look at as we look forward to 2012?
Well, 2011, I thought it was a very good year. Activity was, certainly up significantly, I think, across the board from where we were in 2010. So I think from a relative basis, a very good year. Somewhat fractured marketplace, I guess is how I describe how it finished, in that we had lots of capital in the marketplace, but a significant pullback in the CMBS arena, which led to capital available for the higher quality assets, but for secondary markets and for a little bit tougher assets, B-quality assets, the financing became more difficult, and that did result in somewhat of a pullback in values in that sector.
Well, let's talk about one of the things that might affect a pullback. We asked Jones Lang LaSalle, asked borrowers, 186 borrowers, what your impression of interest rates rising might be. In 2011, 78% thought they'd see some interest rate rise. This year we asked, what do you think about 2012? 57% only, so a lot less people think we'll see long-term mortgage rates rise. How does that really play out for the industry, Mike?
Well, on interest rates, I guess I'd start off and say we have we're in historic low interest rate environment for the higher quality assets, and the benchmarks we're working from have never been lower. So we are seeing for core type financings the lowest interest rates that we've ever seen. And for 2012, we are seeing a lot of capital, a lot of demand on the buy side for the bonds. Certainly the last 60 days has been a significant improvement in the pricing for CMBS. So absolute interest rates are in probably 100 basis points from where they were 60 days ago. So as far as absolute interest rates, hard to say where rates are going to go, hard to outbet the bond market. But with all the global concerns and real issues that are out there, I think no real fear of an interest rate spike. On the other hand, the overall environment is very positive for borrowers who want to take advantage of this low interest rate environment.
Well, that's a good sign, because we do like to think about expectations, and when we think about expectations, we look at CMBS. You talked a little bit of it in the beginning. That market originally last year, we were hearing people say it might be to 50, 70 billion even. Really only ended at roughly 30, Mike?
Yeah, I think it was around 30 in issuance, maybe closer to 40 billion in actual originations. And to put that in context, down from a peak of 230 billion in 2007, but certainly up significantly from where we were in 2010. The first half of 2011 being very active in the CMBS front, and again, the entire market, due to volatility, largely pulled back and very quiet in the second half. Coming into 2012, again, certainly a significantly improving environment in the CMBS arena, where I think expectations for 2012 will be better than 2011. Pretty big pipeline, and again, absolute interest rates which are inside of where they were a year ago. So I do think that we're set for a very healthy market where we'll be filling in from the CMBS side for the non-core type assets and have an active transaction year for 2012.
Okay, well, that's great. We want to see wider availability of capital for a wider set of assets. So this is good news coming from the floor of MBA. Thanks for joining us, Mike.
Thank you, Paige.